Have you ever worried that making some extra money might pop you into the next tax bracket? You'll have to pay so much more taxes and it wouldn't even be worth it? If so, definitely watch this video because I'm going to explain how the Canadian tax system actually works and why making extra money would not result in a whole bunch more taxes owed. Stick around. Hi, I'm Erin and a Canadian CPA. If you are new to my channel, definitely say hello in the comments below. I love to know who is watching. As an accountant, I can understand why most people don't do their own taxes. It's complicated, the rules are constantly changing with regards to what counts as a credit, what counts as a deduction, and the fear of inadvertently creating tax fraud is real. However, there is one thing that I think all Canadians need to know and should know, and that's the difference between your marginal tax rate and your effective tax rate. The majority of people who I've spoken with believe that if you're in a 30% tax bracket, that every dollar you earn is taxed at 30%. And this actually is not true. That's not the way the Canadian system works. So the way our tax system works is that, well, yeah, as you make more money, you do progress into higher and higher tax brackets. But the thing is that all of the earnings that you've earned are not taxed at that highest tax bracket. Only the incremental amount that has passed that threshold is going to be taxed at that higher rate. It's sometimes easier just to read what it says on the CRA website. So here I am on the Government of Canada CRA website. I just Googled income tax brackets, and scrolling down here is where they show the federal tax rates for 2020. So you can see that everyone pays 15% on the first $48,535 plus then it's 20.5% on the next $48,534. So it's not 20.5% on all of the money you've earned. It's only 20.5% on the increment that is above $48,535. If these rates seem low, it's because it's just the federal portion of income tax. Each province or territory sets their own brackets, thresholds, and rates as well. And your total tax or your total income tax would be the combination of the federal and the provincial rate. So to show you how this calculation actually works, let's do an example of someone who earns $50,000 in 2020 and resides here in British Columbia. So I'm going to use an Excel spreadsheet to do this calculation. We've got $50,000 of taxable income. So this person would be in the 20.5% federal tax bracket. Starting off, the first $48,535 is going to be taxed at 15%. We've got to find the remainder. So this amount will be $50,000, subtract the 48. And so only $1,465 is going to be taxed at that next 20.5% rate. It's only that increment that is within that next tax bracket that is at that higher amount of tax. And this is really important to note because while we would say this person is in the 20.5% tax bracket, they're only paying 15.2% of their earnings overall to federal taxes. We can then add in the British Columbia aspects, which works very similar. So the first $41,725 is at 5.06%. We got to find the next increment, so 50,000 minus the 41,725. There's $8,275 that is going to be taxed at 7.7%. Again, it's not the full 50, it's only the increment that is within that bracket. In total, someone earning $50,000 in British Columbia would attract $10,329.04 in taxes, which 20.7%. So this got me super curious. How much would someone else who lives in a different province or territory in Canada have to pay if they earned $50,000? So, well, I did the calculation and here's what I found out. So again, you can see federally, doesn't matter where you earn your $50,000, federally, $7,580 is collected. When it comes down to the differences between the province and territories, there is quite a range. Anywhere from $2,000 and none of it, all the way up to $7,772 paid in Quebec. At the beginning of this video, I said it's important to understand the difference between your effective tax rate and your marginal tax rate. So what is the 20.7 that we just calculated? That is your effective tax rate. Very different from what we would consider the marginal tax rate. This would be the 28.2. The reason why it's important to know what your marginal tax rate is because that's what the next dollar you earn is going to be taxed at. Thank you so much for watching this video. I hope it has shown you that any extra income is good income, and that yes, while you'll be paying more taxes, you're not having to go back and pay more taxes on the money that you've already earned. You will always be in a net positive position whenever you earn more money. Next week, I'm going to go even further onto this topic because we haven't even talked about credits yet. Those will reduce the amount of tax you pay even further. So please subscribe below, hit like, and I will see you next week. Bye.